Hello, hello. Oh, hearing my own voice, but hearing an echo and Tracy is not necessary. All right. Well, I am going to, because I figured this out, hide. Yes, you taught me. I have to remember though. Hide video panel, hide floating media controls. All right. Welcome to Homeownership, not if, but when and how. We're going to talk a little bit about the overall benefit of homeownership. I've got a couple of investors here with us that are thinking more long-term with multiple investments, but also how you get started is to buy your first one, right? So we're going to talk about that, the whens and hows. And then, like I said, if we have some time afterwards, we can talk about the process. I'll pull up a second deck for that and talk about that. So here we go. 90% of millionaires created their wealth through real estate, at least partially. So that's always a good reminder for everyone. Everyone's looking, everyone, I think, especially in the entrepreneurial space, thinks, what if I come up with that $1 billion idea, which I don't say, don't go for that, but let's invest in real estate while we do it. Homeowners have 44 times the wealth of renters. Again, it's that stability piece that leads to that number. Those are the two numbers that I go, okay, so do I have your attention? Perfect. I'm Lindsay Benton. I am the broker owner of Live.Laugh.Denver Real Estate Group. This is our group you'll see here. We are friends who become colleagues and colleagues who become friends. Was an old tagline about our team, and it is true. We have quite the family here as far as how we take care of each other and care for each other and our clients. Our core belief is that everyone thrives when they feel at home. We do have a rental arm that helps renters match up with landlords and landlords meet their renters. Because whether you're renting or buying, you deserve to feel at home. Our big education piece is that don't rent forever if you don't also own some properties as well. But everyone thrives when they feel at home. Our mission is to provide the most professional and personalized experience in the industry by educating and empowering you to make your goals a reality, all while minimizing your stress, maximizing your investment or your proceeds as a seller, and laughing a little along the way. This has been our mission since day one. It's changed a little bit, but the big thing for me was I don't want to just tell people what they need to do in order to build wealth through real estate, but rather educate them so they feel like they're really confident in making their own decisions and on their own path and navigating their own journey. Home ownership, it really is that good. This is the quick and dirty agenda for tonight. It really is that good. It's simple but not easy, and then we'll play the what if game. I was actually just corresponding with my cousin who lives in Chicago, and she said, I just don't know where I'm going to want to be. And she's in her 20s, and I just don't know where I'm going to want to be in a couple of years. I'm like, that doesn't matter. I don't care. I don't know where I want to be in 2 years sometimes. But that doesn't matter. So we'll play the what if game a little bit too. So from a very objective and pragmatic standpoint, the financial benefits of owning is a no-brainer, right? So I think the big thing that I ask buyers and potential buyers to think of is in the long-term versus the short-term. So especially right now with interest rates rising and home prices being up, it's important to know that like you're just getting in the game. You're just getting started. It doesn't have to be the perfect home. I joke like you want 2 bathrooms, settle for 1 toilet, right? Like it's okay. It doesn't have to be perfect. It's just getting your piece of the pie. The tax benefits, but they vary based on if it's an investment or if it's your primary home. But let's just talk about primary homes tonight. So you are going to get to write off the interest for the property. So any of the interest you're paying on the mortgage, as well as property taxes. And then there's some additional closing fees you can write off too if you buy down points or anything like that. That's gonna be something for you to talk with your accountant about. The big thing is the capital gains piece. So if it's your primary residence and you live there 2 of the last 5 years, you can sell it and take all your proceeds without getting taxed. So I'm a big proponent of people evaluating if that makes sense for them. Sometimes it does make sense for them to move their equity into a new property, or maybe move some of that equity into a new property and then potentially an investment home after that. But it is a way to build wealth without having to pay and create an income for yourself without having to pay taxes on it, which, as we know, the majority of us that aren't billionaires have to pay taxes on our income, right? The appreciation. So you get appreciation on the full the full value of the property, which is a great way to be hedging against inflation and building long-term wealth and building up a equity savings without doing much but paying your own mortgage. We always say here, you're paying someone's mortgage, you might as well pay your own, right? So if you're renting from somebody, you're paying off someone's note, right? And so you might as well be paying off your own. And it is a forced savings account, as I mentioned above a little bit with the appreciation piece, but then also you're paying down your principal, adding equity every single month. It really is that good. It is the absolute best way to hedge against inflation. Locking in a low interest payment, relatively speaking, even at 5%, it's low. What'd you say, 5.99? That's for an investment. 6% for if you're buying out of state investment. But if you're buying your primary residence, which is what we'll focus on today, you are getting in at a historical low rate. My parents had perfect credit. They got married at a very young age. They were, ideal borrowers. And for their first home in the 80s, they had a 16% interest rate. So when we think about how home prices have increased since then, obviously home prices were different there with Springfield, Illinois, and interest rates were higher. Home prices nationwide were less. But we're still historically low. I mean, when they were in the 3s, we were like, people would be like, I don't want to have to pay 3.5. I heard somebody got 2.95. I'm like, that's the hill we're dying on. Like sometimes people are paying 12%, and when we think about consumer debt, which we're going to talk about a little bit more, you're paying much higher interest rates on that. And then obviously the assets appreciating, which is what we go back to every single time. And that's just the huge piece of owning real estate is the historic data that just confirms it's going to continue to appreciate, even if it's not at the double-digit level that we've been seeing here for a while. There are so many psychological benefits. So for everyone on the call and in the room, like, please know this is for you, but this is also for you to spread the word. Everyone should feel empowered to buy a home if they want to. If they don't want to, have them call me so I can understand why. But the psychological benefits also are just tenfold, right? So you have housing stability, which leads to lower stress. And then when you're not as stressed out, you make better decisions, right? You're locking in that housing cost amount. You're in control. I always hated like not knowing in college. We moved every year and it was like, oh, where am I going to live next year? I hate that feeling. When you own the home, you get to decide, am I going to stay there or not? There's a ton of data around children's levels of stress, anxiety, and then how that affects their performance in school. So housing stability is something that we definitely look at both, individually per family, but then also from a community level, that housing stability is so important in order for children to really benefit from their education systems. A lot of times it's healthier living conditions. So even if you have a good landlord, they're not going to necessarily make the move to make the fixes as quickly as you would as a homeowner. And that's definitely a benefit of owning your own home. The other side of that is if they're not a good landlord, then they're not going to make the improvements at all, or at least not at a quick enough pace. And obviously there's pretty significant environmental concerns, whether it be, mold or asbestos, or, there's different things that can really cause long-term health concerns and effects. You get to paint the walls what you want to paint them. You get to put up wallpaper and not have to paint over it. In college, we had this color of, it was like a yellowish, Larson was the name of the company that owned, I think it was Larson, that owned all the properties. And we called it like Larson white. And it was just like yellow, white, whatever. And so whatever you did, you had to like repaint your apartment that color when you were done. Even if you didn't paint the walls, you just had to, because because of the dings or whatever, right? So we all just had like 5-gallon buckets you'd pass around the apartment community when everyone moved out. And I just remember thinking like, this is a racket. This group makes us all do this for them. But that's what happens when you're the landlord and you're a slumlord on a college campus, right? And then you can really rely on your home equity as a rainy day fund. While we don't want to leverage it for a vacation or shopping, it can help if you get yourself into a pickle or if there's medical bills or something like that. And then of course it can be used to buy other properties as well. The community benefits are huge too. Again, there's a ton of data around this. I'm not somebody who loves to like
dig into like the percentages and all that, especially when it comes to subjective benefits. But you see that, you know, the sense of community, you're going to be more invested in creating relationships with your neighbors when you own than if you rent. People take better care of their homes usually, obviously, than a tenant would. I mean, we've all seen that difference, right? And then there's also the like patronizing of local businesses and volunteering in your community, getting involved in different organizations. So there's definitely a benefit of living in the home you own and, you know, contributing to your community around you. It is simple, but not easy. So I think home ownership, I spend a lot of my time educating about why we need to do it. And then people go out to do it and it can be discouraging, right? Because of all the things you see in the headlines, whatever family and friends are feeding you. It could be on your social feeds. I feel like social media, and maybe it's just because I'm in the industry, but it's like my feed on Instagram is constantly like, it's so hard to buy a house right now. Well, a lot of the time, things that are worth it aren't that easy. So it's simple. It's not easy. That's what you have professionals to help you with. An ideal scenario for a borrower is their W-2 employee. So it's really, really predictable income. And they have that basis of income as well. They're a 640 plus credit score, and they have a 3 to 5% down payment for a first-time home buyer. You know, we're out there with first-time home buyers competing against folks who maybe aren't buying for the first time, or maybe they have some generational wealth that's been gifted to them and they're putting 20% down, 30% down. And we're dealing with that all the time. But the traditional ideal scenario would be those three factors. The reality is you may have made career changes, you may be a contractor, you may be a business owner. And so maybe you're not as straightforward as a W-2 employee. That drives me nuts as a business owner, because I'm like, why are you penalizing those of us who are like willing to take risks? But I also understand from like the insurance backing piece of it, it appears better if somebody's a W-2 employee, it appears more stable. To me, I'm like, a W-2 employee could just as easily lose their job the next day as someone could lose their business, right? So, and then there's cash income. I do the ... There's different industries that lead to a cash income. You know, one of the things happening in the early 2000s that was featured in the Big Short movie about the housing bubble was a lot of adult dancers. What's the technical term? A lot of adult dancers, exotic dancers, adult entertainers were a cash income, but they were able to qualify for homes. So we had adult entertainers who had portfolios of homes, and they were qualifying because they didn't have to have, it was stated income. That's what was getting approved. And a lot of those women, is who was highlighted in the video, I'm sure men too, they did fine. I mean, they built a great portfolio of rentals with all cash. Part of cracking down on that, because there were people that were stating income that they weren't necessarily actually getting, was doing away with the stated income loans. Additionally, there was a dog in Florida who did get a home and a loan through stated income. Correct. Leave it to Florida. All the jokes about Florida, they're kind of correct. Marty could own a home. Yeah, he's showing off now. The other reality is getting 5% together right now on a home, if it's $400,000, that's $20,000. That's a lot of money. It's not like getting 5% for a $50,000 home, right? Or like back in the day, or even like a $200,000 loan. We were talking about $250,000. Like $250,000 used to be kind of an entry level point. We don't have that here anymore. And so getting that down payment together is really hard. So we are relying on a lot of down payment assistance programs, and there's some that are through the state. And then there's also additional ones that different banks and grantors offer. And so our job is to have a pulse on what those are for our clients, and then also know the resources we need to ask for when there's new ones, because there's always going to be new ones. So keeping track of all those. And then of course, the credit repair optimization piece. You don't know until you know what your credit is. And a lot of times we go through life, we're not necessarily educated about it, or we see a false credit because we bought a car, or we got something in our email or whatever it is. But ultimately, your credit score for buying a home is different than what it is if you go to open a credit card or if you go to buy a car. And so really working with a lender or a credit optimization specialist to ensure you've done everything you can to make sure that your credit is as high as it can be. It's really crazy. Like at 638, you're going to have a different interest rate than at 640. And so there's little tweaks that can be made. And that's where we really lean on lenders and their credit departments to ensure that if we can make a little bump to make a difference in someone's monthly payment, we're going to do that. All credit's not created equal. I touched on this a little bit. My favorite one on this, and I always have to tell the personal story for a couple of reasons, but cars are not good for your credit. Do not spend money on cars. If you're under contract on the home and you buy a car, you will no longer get your home. It's expensive. Cars are really expensive, and it's a huge debt to income issue.
That's only if you have like a loan on the car. Buy it all cash.
Correct. Yeah. So credit for the car. Yeah. If you buy a cash car, it doesn't matter. Any kind of consumer debt. I mean, anytime you're asked at a store, like, oh, looks like you qualify for a credit card. Do you want to open one? Like the answer is always no. It's no. We go out and we seek out credit cards that are right for our situation, and we put those plans together. We don't say yes. So the shoes are there because I feel like I teach these classes, and I also should share one of my biggest like credit messes, which was, well, one, when I bought my condo and I was 23, I had a medical bill that I didn't even know about from when I was in college. And I didn't even know I had gotten a bill. I thought I was like on the university healthcare, excuse me. And I had a bill. It was like $300. I didn't know about it. Showed up, totally messed with my credit. So we had to pay it off, and we had to show, when I bought my first home, it was really a pain in the neck. Well, fast forward, I'm a full-fledged adult. I'm like 28, and I'm going to a Christmas party with my best friend, and it was a Christmas party, and I wanted red pumps, hence the picture. So I popped into Macy's and I found red pumps. They were Jessica Simpson. They were great. They were like real hot. I had them for a long time, wore them probably 10 times. I had them for a very long time. They were $35. What a deal. Oh, I'm at Macy's. Yeah, I have a Macy's credit card. I don't have the card with me. Oh, I can just punch in my social security number. Jesus. Okay, great. Because you can do that. So I punched in my social security card. This was in December. Great. Got my new shoes. I'm going to go party. Forgot completely about the fact that I didn't just buy them. I like put them on a credit card while I had moved out of my condo for about 8 weeks. And in that, the mail lost me. I went months. Those shoes ended up costing me $300. And it was not good for my credit, right? So that's the kind of stuff. I obviously know you would never do this. I know you would never do something that stupid. Matt, I can see you moving around a little bit, and forgetting too, right? Like, and it was an honest mistake. It wasn't like I didn't want to pay for the shoes. But that just to show, like, we all do things like that. And then I was like, oh my gosh. And I was so ashamed, right? And like embarrassed, like what a stupid mistake, and all for these stupid pumps. So funny. They did have a great little peep toe. I have to find a picture of them. I say that every time I talk about this. But I share the story to say, like, we're all on the journey of learning this, right? We're all learning this as we go. Obviously I was able to repair it. I paid them off, whatever. But the fact that so many late fees, I mean, they were like $300 shoes. I don't buy $300 shoes. It's just not where my priorities are. So that's just to keep in mind, consumer debt, like really minimizing it. I also, when I moved here, like I bought my condo, and the furniture stores do 0%. So once you close, if you need to furnish a home, it's nice to be able to do 0% on furnishings for 3 years with Furniture Row, right? But then, that sits there until you pay it off, right? So it's just keeping that in mind. I had that. I was like making money and spending it and opening all the credit cards and being 23.
You want good debt.
I know. So what's good debt?
What? Houses.
Exactly. So houses, I've had somebody tell me like, if I buy a house, it's going to affect my credit only positively. So it'll obviously affect your debt to income ratio, bringing your debts up versus your income, but it's going to affect your credit positively. And then student loans are actually net neutral. So they are now not affecting your debt to income ratios negatively. It does sometimes depend on who's holding that loan, but as a rule, it's net neutral. Yeah, buy houses. So I like to talk about, having your priorities. And I think, everyone's experience, and you feel like a dog chasing your tail. That's why that cutie is in there. It's hard when you're on a longer journey, right? You're like, okay, I'm putting together my plan and I have 12 months until I'm going to buy a home, to not make a mistake along the way or make an impulse purchase. Or, I have adult, clients that are in their 40s that like buy a cold bath. What are those called? Like the cold. Yeah. He got a sauna and like cold plunge pool.
Oh, okay.
Yeah. For his house. And I was like, I love you. Stop buying that shit. Like that's money you could be spending or putting towards your, savings. But it can be frustrating because you're making all this money, but you're not where you need to be in order to make the purchase. And so you buy other things that are like a quicker benefit. So I always tell people I've never been great about keeping a budget. However, I always spend far less than I make, and that has benefited me. I live a simple life. So I always make sure I pay my bills first, and then you pay your savings next, and then have fun. I've had people tell me they're going to try and pay off credit, or they want to have a savings account so they haven't paid off their credit card. No. We pay off the credit card because the credit card's costing you 20% to hold. The savings account is not earning you 20%, right? And so really prioritizing it that way, it can be challenging in the moment, but it's the right way. I actually quoted Jay Shetty, who's a great podcaster about mental health and physical health. And he said something that feels good now will always feel worse later. And something that is harder now will always feel better later. Right. And it's like, we were talking about it as far as, habits with building business and all that stuff, but same with, that quick dopamine hit of the new shoes is not going to benefit you later or like going out to dinner versus just cooking at home. It's like, oh, it's fine. It doesn't matter. So being intentional with your spending, and then obviously, like I said, making more than you spend, and then being proactive versus reactive. The hardest thing for me to do as a single working professional was to like bring my lunch to work, but not bringing your lunch to work. It was like $20 a day to like get lunch. And I mean, still is, but like in downtown Denver, I'd be like, I guess we're going to lunch again. Like there goes, that's $100 a week. So those are big changes you could make. What?
I was gonna say, you get like a $5 salad from Trader Joe's.
That's not going to lunch.
Okay, we're going out to lunch, but if you have your lunch, then
You can bring a $5 salad. That to me counts
you
as
wouldn't
food
bring your
prepping.
lunch to like a restaurant.
Right. This was like going out. I worked on 16th Street Mall in 2004. And so we would go to lunch,
That makes sense.
Yeah.
Gotta
No,
have a lunch.
if you bring a pre-made salad from Trader Joe's, like I'm for sure getting you a badge for like responsible adult. That's tough.
Yeah.
You don't have to like make it all. But yeah, it's that proactive piece, right? And that's the best way to be able to really, save up the money and stash it away. And it's the same way, I use lunch as an example, $20 a day, but there's other people where they're going out to a happy hour. That's maybe $100, right? And those kinds of things add up. And, I like to say like, it starts with $10, right? And then you're kind of like tracking your money in hundreds, and then you're tracking your money in thousands, right? As you make more, you spend more, and life gets more expensive. And so it's really at what space and place you are with that. But yeah, being proactive versus reactive. So you're not just catching yourself going, oh shit, I just spent, $300 this weekend on what? And then there's the what if. I put this together right after, I guess sooner after, more recent to Elizabeth Warren, always having a plan for that, regardless of your political thoughts on her. I love that she had a plan for everything, and I have an answer for everything. The only time I struggle with somebody saying, you should buy a home now is if they're like, my rent's $700. I'm like, well, you've achieved the unachievable here in Denver and you have a very low rent. But then I usually find out that there's roommates involved, and I say, oh, great. Okay. So your opportunity is to buy a house and have them rent from you, right? House hack it. So I can usually find something for them to do. But what if I want to move? When you sign that you're buying the home, you're intending to live there for a year. You can move, circumstances can change. If you're signing to intend to live there for a year, the lender is not going to come after you because you got a job offer in Texas and you transferred, right? So like there's realities that happen. You need to sign with the intention you need to move in. It's too small, it's too big, life changes. Great. You can sell it and buy something different. You can keep it as a rental, buy something different. Like once you own the piece, you have all the flexibility. Obviously, if your job moves you, you can actually sell if they move you out of state, sell and not pay capital gains on it, even if you haven't lived there 2 of the last 5 years. And then, what if a recession hits? You just hold on with all your might, right? You hold on with all your might and you make sure that's the bill you pay first. I also tell the story about, we used to send checks for car payments. When I moved here, I got myself a Jeep Liberty. I loved her. And it was a 5-year loan. And by the time I was paying the final year, we were in the recession. And as a salesperson, my income had gone down drastically, had decreased by about 40%. And so I would literally pay my mortgage and I would write the check to Jeep and not sign it. Because I knew by the time they got a hold of me, I didn't do it every month, but I did it a couple of times. That by the time they got a hold of me, I would have gotten my second paycheck so I could pay it, right? Because it's like, you got to do, and I would for sure was not calling my dad. I was not going to call and ask for help. Like I was figuring it out, but those kinds of things, I did that in college too, for the Chevy Cavalier I bought. It was a good trick. We don't have live checks. I mean, no one does checks anymore, but it was great. I was like, it's in the mail. Like the it's in the mail game was awesome. But also, being strategic, like one of the things I don't feel like I was educated on when I bought my first home is there is a grace period. So most of them come with 15 days. You don't want to get in that habit, but if something comes up, flat tire, something to where you have an unexpected expense, you have no choice. You can usually get yourself caught back up. If you lose your job, I say you can always move in with family and rent it out, move in with a buddy, rent it out, rent a room somewhere while you rent out your home to cover the mortgage. There's always options once you own. So I always have a plan. I have a plan for that. What if? Which loan's best for you? I'm not a lender. I'm thankful to not be a lender. It's not the way my brain necessarily works. I'm thankful to know a lot of incredible lenders and work with lenders that we really trust. And we're always happy to connect our folks with them. The biggest thing to keep in mind is the monthly payment. We always talk about, you don't live in the purchase price, you live in the monthly payment. And so with that in mind, that's how we're backing into things. As far as like the best kind of loan, it really depends on the situation. The HOA may allow for certain loans and not allow for others. So condo buildings have to have approval for a VA loan at some point in their history and it stays approved. And then if they get approved for an FHA loan, they have to re-up that approval. And so a lot of condo buildings, thinking like Cheeseman Park, the buildings that were built in the 50s, 60s, 70s, had the FHA approval because there was a time that you either put 3.5% down with an FHA loan or had to put 20% down for a conventional loan. So obviously as a condo, that's an entry-level property for a lot of people. Some people it's a retirement property. I think they're great. But anyways, it's a lot of times like an entry-level price point. And so they were getting the FHA approval. The HOA was doing the work to get the FHA approval. Well, then as home prices went up, conventional lenders knew that they couldn't just do 20% down. And so now that's why we see all these 15%, 10%, 3% even for conventional, as well as 5%. And so condos are going, hey, if someone can qualify conventional and do 5%, we don't have to do the work to be FHA approved anymore. So that's something to take into account. The interest rate can vary. An FHA loan, it doesn't matter what your credit score is, as long as you qualify, you get the same interest rate. So that could be beneficial for folks who have more credit challenges than others. Whereas the interest rate will vary for a conventional loan based on your credit score. So you want to take that into account. And then there's great ways to project those interest rate differences and when you're going to make the money back and if it makes sense to bring the extra 5% down or not. There's an interesting fun fact is that a lot of times your payment will be lower with 19% down than 20% down. Once you put 20% down on a primary property, you don't have to pay mortgage insurance. And your interest rate will be a little bit higher for that because the banks feel like the back end, like the secondary feels more confident in having that insurance, that mortgage insurance paid. And so it's so small that it can make sense to do 19% down and pay that mortgage insurance up front. And then your actual monthly payment significantly lower. How about that? How about that little tidbit?
I thought 20% is the minimum. They'll let you do 19.
For owner occupants.
Oh, for if you live there.
Yes,
Got it.
owner occupant. It depends on the length of time you intend to keep the loan, not necessarily the home, right? So a lot of us were buying points because it was 3.5 and there's no way rates are going lower than that. And they went lower and we were like, well, shit, I just put a bunch of money up front, right? I paid off mortgage insurance or whatever it is. So it's really evaluating how long you think you're going to keep the loan. Right now, we're discouraging people from paying points because we think that we'll see a dip. We think we'll see interest rates dip back down. So we don't want to buy down that point, give that cash up front to then have to refinance out of it anyways, because you don't get that money back. You don't recapture it. Obviously, down payment access, depending upon what people have access to, will dictate what loans they qualify for and what loan options they have. And then, like I said, the loans that are available on the property. We like to say that the seller doesn't dictate what loans are available for the property. We encourage our sellers to accept any loans that the property would qualify for. So VA and FHA is going to have a health and safety inspection along with it. That is government mandated to ensure that the homes that they're backing are safe. It's a protective measure they take for consumers. I will tell you, I have way more health and safety issues come up for conventional loans than I have ever had for FHA and VA.
So they're almost like a general contractor for you, but like for safety and health, they're not looking at like piping and stuff.
Correct. They're not checking outlets. They're like, is there any lead-based paint that looks exposed, right? Is it livable? Are there toilets? Like they're looking, there's a checklist that's public facing of like what they're checking for, but it's definitely not a full inspection. The appraiser actually does it. It's a site inspection. Yeah. Any questions before I myth bust? Sorry, I don't have as many props as those guys. The biggest myth we hear, and the one I like still, I feel like I've talked about this so much that I'm like blown away when people still don't know, but then I have to remember this is the space I live in. So of course I feel like everyone should know. I talk about it all the time, but you do not need 20% down to buy a home. The majority of people are not putting 20% down when they buy a home. Even when we looked at data from last year, it was 6% down for first-time home buyers, even given the cash-heavy environment we're in. And it was 14% down for non-first-time home buyers. They could have been buying for the 10th time, but anyone who was like a repeat buyer. So the average is not. Part of that is because you don't have to tie up the cash if you don't want to, right? You can use the cash for other things. So we're not necessarily saying let's put the 20% down. Yeah, like I said, there's 3.5% if you serve. If you're a veteran, you have access to a VA loan that's 0% down. There's even some local banks that do 0% down. It's hard to get, sometimes it's hard to get those banks under contract because they don't necessarily move at the pace that the market moves at. They may take 45 days for a loan or something like that, but there's really great programs out there. I'll just wait until the market slows down or the bubble bursts. This is my favorite. And I say that sarcastically. In so many ways. One, ultimately, the housing market is dictated 100% by supply and demand. We will continue to have a shortage in supply. People are living longer. We're not finding, there's not more land just hidden in Denver proper that no one knows about, right? We can continue to expand out, but then eventually everyone comes back in. If we, as a country, start getting technology into the rural areas, we will see, I can't say rural, even though I come from a rural area. Oh, that was better. Yeah, it's hard. I like roll R's all of a sudden. The only time, yeah, I'm like, rural, like what? Anyways, if we can get the proper infrastructure and cable and all of that with internet speeds, I think that we'll end up being able to expand into some smaller communities with housing demand. But until then, we're really tied to the areas that have that kind of technology.
There's a statistic last June where it was like a 30-year high of all the permits pulled for like building houses.
Yes.
But that won't hit the market until a year and a half at least.
Yep. So we've had highs for new build activity. And then, but part of that is because everyone paused with COVID. So, and then the homes that were started before the pandemic had delays in finishing because of supply chain issues. It's been really crazy to watch the new construction. So then we saw this huge influx of new permits being pulled because so many builders had paused to see what was going to happen. Everyone was like, what's going to happen? Little did everyone know, although some of the like bigger economists, speculated this, is that the houses were the new toilet paper, like it was like we couldn't find any, right? Because home became that much more important when there were stay-at-home orders. It'll be interesting to look back in 10 years of like this time, because it was just such an interesting response and how it affected the economy and all of that. So we will see, and we saw actually a good swoop of new inventory get finished last September, October, which we saw a little bit of a breather. It doesn't all of a sudden become a buyer's market, but it's not as severe of a seller's market, meaning there's not as severe of a shortage. And we'll continue to see more of that. Ultimately, though, you see it and the price points they're building at, it's not attainably priced. I mean, in Denver Metro, we're starting single family homes, majority of them starting at 500. That's not necessarily entry level. So we're having to wait for someone to sell an entry level home to move into those, to get access, to get new people in.
Sloan's Lake, it's pretty good.
Sloan's Lake.
Yeah.
It's just, you can't get a townhome under 750.
Really?
Oh yeah. Yeah. Valverde, maybe like further south of Sloan's Lake.
Maybe, yeah.
Yes.
You guys know better than me.
Yeah. Sloan's Lake's it's been popular for a while. Yeah. It's a hot neighborhood. It has been. I would say those south, like, so a lot of the areas that we're seeing post-war housing. So that's the homes that were built in 40s, 50s, 60s. That's where you see the 800 to 1100 square feet up ranches on bigger lots. Valverde, Barnum, Westwood, those are neighborhoods that are Sloan's adjacent or just south of Sloan's, where we're seeing still some entry-level homes, but they're in the mid threes. Yeah. But yeah, I was just talking with one of our agents, and she was competing on a townhome that went from 650 to 750, listed at 650 and sold for 750. Yeah. For like, 1,500 square feet. So yeah.
Do you have a question?
Oh, sure. Yeah.
Are there options if you have money for a down payment, but not enough sources of income?
So it really depends on what those sources of income are. And I'd want to connect you with a couple of specific lenders that could help navigate that. There are asset-based loans. So it can, if you have a significant amount of assets, you can basically borrow with those as your backing. So yeah, we have some specific options for that. So it really is so circumstantial, case by case. Good question. The bubble that burst that we know of as the housing bubble of 08, 9, 10 continues to have its effects, was caused by predatory lending practices, as well as unintended relationships between lenders and appraisers that were putting people underwater on their homes. So basically, if I was the lender and Tracy was the appraiser, I'd say, hey girl, I need this to appraise for 700. They'd be like, okay, cool. Even though really the comps only spoke to about 650, and it was just one thing after another. And then the homes were getting valued too high. So a lot of things were put in place to ensure that that wasn't going to happen anymore. One of them, as I mentioned, is the stated income loans are no longer available for dogs or humans. Stated income is crazy to me that you could ever be like, that's how much money I make. Like, that's insane to me. We are starting to see more where you're able to use bank statements for verifications. You're not necessarily needing to see the W-2, but you can see the money coming into a bank statement, which would allow for more of our like cash type of employees or cash type workers. So we're seeing it loosen up a little bit, but now the appraisers are all going through a third party. So the lender is not selecting the appraiser, and instead they're going to an appraisal management company, the AMC, and they don't ever talk directly with the appraiser. They aren't allowed to. And so that's what's eliminated that. The bubble won't burst because we don't have the overvaluation of properties happening. Additionally, the national average of a percentage of equity in homes is 40%. So in order for someone to foreclose, right, they need to owe more than the home is worth. If a home already has 40% of equity in it, let's say it's a $100,000 home, they only owe 60 on it, there's 40,000, there's so much room to get out of that home and still not foreclose, and therefore they're not underwater on their home. So there's a lot of things contributing to the bubble not bursting. Did I get a question? No.
No.
Okay. Always happy to talk about it. I will keep buying real estate. Myth number 3 is I need perfect credit. I feel like these are like, a lot of times this is like, I don't want to eat the elephant yet, right? Because like, how do you eat an elephant? One step at a time or one bite at a time, right? Like getting into the home ownership game and like getting started with that is a big undertaking. And so a lot of times people kind of stall with excuses. And one of those is I need perfect credit. You just don't. Perfect credit is kind of not existent anyways. And the credit is an algorithm that doesn't always make sense. That's why we have professionals who help us maximize our credit and optimize it. So you don't need perfect credit. You do need good enough credit. And it's 580 for FHA loans and 640 for conventional. And yeah, it doesn't need to be perfect. And it's not what you see when you buy a car. Oh, I went over all these. I don't know where I want to live in a year, let alone in 30 years. A 30-year loan, like that's a lot to think about. Don't worry. That's where I just always go back. Do you know where you're going to be in 30 years?
No.
You're going to own 200 units. I believe that.
That's my goal.
I believe that more about you than anyone I've ever met.
I don't know where I'm gonna be.
You don't know where you're going to be exactly. Hopefully on vacation,
Yeah.
right? But that's what I tell people is it doesn't matter. You're paying to live somewhere. You might as well pay your own mortgage and you can keep moving that where you want to, or you can keep it or whatever it is. So I like how harumphy she is. Like, I don't know where I'm going to be in 30 years. I can't get exactly what I want, where I want now. He's also harumphing. He's definitely looking at Zillow and is like, oh my gosh, or like Redfin. And he's like, that's weird. The value of the home was different. And then once it went on the market, they increased it by 100. Yep. He is, yes. You don't always get what you want exactly, right? And sometimes that's just life. You got to buy what you can now and you have to compromise on something. I really wanted a 2-bedroom when I bought my condo, and the 2 bedrooms I could afford were 2 tiny bedrooms. Like you couldn't even put what I felt like a proper like bedroom set in them. And so I ended up compromising on rooms and I ended up with a really big 1-bedroom, and it served me perfectly. And I don't think it's really affected its rentability because a lot of those places that had the 2 bedrooms, really one was going to be an office. Like it wasn't big enough, the ones I was looking at. And so that was definitely one thing where I was like, I'm told I'm supposed to get 2 bedrooms. I read that on the internet. And then as soon as I let that go, I got into the place that was perfect for me. And that's, I think I've talked about it before. I still own it, my bachelorette pad. And I ended up just madly in love with it. And I was so glad that I had changed my view on that, because I was looking at 2-bedroom condos in like Cap Hill. And then I ended up looking at 1-bedrooms in 5 Points and loved the building, 13-foot ceilings. Like it just changed the whole perspective for me. So we talked to, a lot of people come to us and they're like, I want a 3-bed, 2-bath because that's what people want. It's 3 bedrooms and 2 baths. I'm like, what are you going to do with all the bedrooms? Tell me about it. You may need 3, you may need 5. I don't know. But what are we going to do with them? And so it's like, well, I need to have a spare room. I need to have an office. I'm like, okay, here, office. Like, what if we instead just had a nook, right? Like we don't need a proper bedroom to make an office space. What if there was a space somewhere, or could we add one or whatever? So we always are digging in to understand why. I always tell the agents, make like a toddler and ask why 7 times, and we'll get to the real root of what people want. So it's really about figuring out what you can get now and going from there. Because saving to buy what you want now is going to just keep getting more expensive. So you might as well get a placeholder of some sort and then let it grow, and then you can grow into the next thing. I don't want to deal with all the maintenance. It's true. Homeownership, and we send out a couple emails a month, and we speak to this, is home maintenance. You have to maintain what you've invested in. And it's one of those things where it's like, it's simple, but it's not easy, right? And so maintenance levels vary based on the types of homes you're buying. And that can be the benefit of an HOA. Some people will be like, $300 a month for what? And I'm like, well, you pay significantly less in homeowners insurance, usually about $100 to $150 less a month in homeowners insurance, because a policy for a home, let's say entry level, is around $2,400 a year. For a condo policy, it's about $400 or $500. So it's a huge significant decrease in the monthly payment from that. And then also, you may have water covered in that. You may have, you can kind of back into how much the HOA is actually costing you each month and then project it onto, do you have a gym? So you don't have to pay for a gym membership anymore. So it can make sense. And then you're in a lower maintenance situation. Oh, that's about the brokerage.
Or you just buy like really new home. And
A really new
with
one.
like warranties and stuff.
Yeah.
right?
Yeah, a new home. They usually come with, so every home warranty is a little bit different, but they're usually like bumper to bumper for a year. So like if anything goes wrong, they'll come in and fix it. And then like structural for 10 years, and then like plumbing and electrical for either 2 or 3. So they have that warranty component with them. So we always like put reminders in the calendars of our buyers, like it's been 10.5 months, go through your home or bring in a third party inspector, get your whole laundry list of stuff you want done by the warranty company.
Yeah.
So they can fix it. And then, you go on in your happy way. And there's also third party home warranties. So if it's not a brand new home, you can buy a home warranty. I am not good about using warranties, right? It's kind of like if I get offered one on an electronic, I'm like, no, I'm never going to remember that. Right.
Or
So-
make use of it. Unless it's only good when you need it.
They're only good when
It's
you
like-
use them.
Yeah,
But for some buyers, they're buying a home and it's like 15 years old. And so all of the like major mechanics are 15 years old. A home warranty makes sense all day long because it gives them 12 months of protection if any of those go out. As landlords, it can be a good option to pay, $500 to $700 a year so that if any of your major appliances go out, it's taken care of with like a $7,500 depending upon your deductible. So it's like an added layer of insurance. Yeah. Did it. 6:49. Perfect amount of time for Q&A. Any other questions from video? Do we want to talk through the process real quick?
Sure.
Like the step by step? I am going to. See if I can find it quickly. You guys can watch me try and search Canva for things. And time.
okay, but
We use it for marketing.
yeah,
It's so good.
it is.
It's so good. And try once, and then we're gonna just wing it. Boom. So this is our how to buy a home deck. We changed it up from here to kind of talk a little bit more broadly, but just to set some expectations about around the home search in general. An average home buyer search will include viewing 5 to 10 homes. I feel like there's a lot of things out there. It's like, I looked at 300 homes, I wrote 444 offers, and I finally got it, right? We help people invest their time wisely. And so I think that that's part of it, is helping people know what they're looking at. If they have an option, if they have a chance of getting it, whatever, you may have to write multiple offers. It's not always, and given the current buyer to property ratio, we're writing multiple offers usually for clients.
Newbie question, but if
Yeah.
you make offers and all their seller receives multiple offers and they accept one, does that make all the other offers invalid?
Correct.
Okay, but then if it falls through, then what? It just goes back on the market. You have the person, if you made an offer and didn't get accepted, you just make another offer again.
Yeah, great question. So we can go into backup position. That's if a seller is willing to accept it.
Backup position.
So you could go into a backup offer position. So let's say that a seller gets 5 offers, the top 2 are really close. They decide to go with offer 1 and you were offered 2. Your agent can buy for you to get in a backup position. The backup position is only of benefit to the buyer. The seller is then obligated to sell to the buyer if the buyer wants the home at the time it comes back to market at the agreed upon terms.
So they accept it they accept the backup offer and then they're tied to the backup offer.
If the first one falls through.
If the first one
Yep.
falls through.
That's why it benefits the buyer, not
Are
the
you allowed
seller.
to change the terms of the backup offer?
Yes.
So you can
Before you
even
go up.
a little bit lower or something?
It depends
Just
what
like-
you get negotiated. A lot of times the listing, as a listing agent, I would say, here's what I need from you in order for the seller to consider the backup offer.
Yeah.
And so then the buyer can write it or not.
Mhm.
So it does benefit the buyer. The way it benefits the seller is that the seller's agent can then say during negotiations with offer one, we have a backup signed, we have somebody ready to go, right? It's that competition piece.
Oh, yeah, I see.
Yeah.
I see.
So it's all negotiation, right? Yeah. I will say that in every state, and especially in Colorado, the buyer is always going to be protected first and foremost. They're one, the ones taking on the liability, and two, the one not in power, right? So you're taking on the liability. So if you want to inspect and get your earnest money back, so long as the contract says you still have that right, which we're always writing contracts that way, then you can. So you get under contract, you say, I'm not going to ask for anything. There's huge structural issues. You can still walk from the contract and get your earnest money back. You don't get your inspection money back.
What about Texas?
I don't know tech. I'm not.
I know your focus is not.
Matt,
I know, sorry.
Matt, who's with us tonight, is going to invest in Texas. We've talked about it, which is fine.
Yeah.
But I don't know Texas. I don't know a Texas contract. I know. So as agents, we pass a nationwide test,
Yeah,
and then we pass a test for each state we're licensed in. I'm only licensed in the state of Colorado.
it's okay.
No, I feel great about it.
No, Colorado's good. I mean, we're all good, you know.
Yeah. The website and the MLS, our website ties with the MLS. The MLS is the multiple listing service. Everything you're seeing on Zillow, Redfin, any of those other brokerage sites is coming from an information data exchange called the IDX that comes from the MLS and goes out to those properties. So sometimes clients will be like, well, what if I see it on Zillow and it's not on your site? I'm like, well, that's not how it works. It's just maybe where you see it, or it may be that you have different search parameters in your Zillow app than you do on your site, on our site. So that all is out there. What I tell clients and what I tell my agents is if you're not looking for inventory outside of what's on the MLS, we're not doing right by our buyers. We have to be keeping an eye on other opportunities for buyers because there's sometimes options out there, whether it's new builds. A lot of new builds are not on the MLS or not, at least not comprehensively. And then also there's versions of for sale by owner. So maybe an investor who's thinking about selling or whatever, there's kind of like it for sale by owners are 7% now. In the 80s, they were more like 27%. So obviously that's shifted a little bit, but we're always looking for stuff that's going to come onto the market or how we can get you a leg up. Do your own research too. We always tell people drive by the home. Like, I'm not going to live in it. You're going to live in it. Like, you should drive by the home. You should get a feel for it. You should check out the parks in the area. You should check out the restaurants. Like, that's going to be your home. And then same with once you get to the HOA documents, if you're in an HOA, like, I'm not living there. You're the one who's coming into this homeowners association as a homeowner and a member. So do your research. I check it out on Google Maps was especially important during the pandy because we couldn't really go in the homes. So we didn't do as much in-person show. It was very weird. It was a very weird time, you guys. But seeing on Google Maps, because sometimes what you see when you drive around a neighborhood, like I always like to look at an aerial and be like, okay, that's the place I want to check out. That's whatever. So I'm always like, look at it from above and then go check out the area. I will say that the pandemic upped the game for a lot of agents as far as doing virtual tours. I see it as more of a standard now. So whether it's a video walkthrough or one of those 3D walkthroughs, it's easier to walk through a home from your computer or your phone now than it used to be. It's more frequent. Be ready to get competitive. We have a whole list of offer variables and all the different ways you can make your offer more appealing to the seller. And it doesn't always just mean highest price. A lot of our clients get under contract and they're not the highest price, but the best variables in the offer or in the actual contract based on the questions we're asking the listing agent to find out from the seller. So really seeking those ideal terms for the sellers can get you as the chosen offer. It doesn't always have to be the highest. Yeah, long-term versus short-term, we're going to play out those numbers too. If you pay a little bit more now, then waiting, then having to shop for 6 more months. If we're appreciating at 1%, that's 6% appreciation. So you're gonna be paying 6% more because we're appreciating at about 1% a month right now. You're gonna be paying 6% more in 6 months anyways. If someone wants to get a deal or just throw their hat in the ring, I'm always like, wait for it to be on the home, for the home to be on the market for 7 more days, 1 weekend. Our kind of cycle we've fallen into in the last 7 years is we list on Wednesdays and Thursdays, show through the weekend. If there's an offer or multiple offers over the weekend, it's getting negotiated and going under contract Sunday, Monday, or Tuesday. Usually Sunday or Monday these days. And if it makes it through that, then there's a good chance that you won't have as competitive of a situation. Also look for iPhone photos or ones where people take them of themselves. One of my favorites, I still pictured in my head, is the toilet seat is up. The candle is on the back of the toilet. It's lit lighter next to it. And that's how they presented the bathroom. I was like, someone's getting a deal. Like, so funny to me. I love it.
You see the people in the photos.
When you see the people and they're like, it's like they're in the mirror. It's my favorite. Yeah, the reflection. Yeah. Like I said, agent creativity is super important. We're always leveraging our sphere, and then inventory from withdrawn or expired homes too. We're not necessarily like cold calling them to get the listings. I'm even like trying to collaborate with their original agent, especially if it's withdrawn. And this has been beneficial to get a buyer under contract, especially if that seller has to sell to buy. It can be beneficial for them because they can take their time. So we can do like an extended contract period.
What's a good way of like being able to tell when, if something falls through? Let's say they don't have a backup offer in place, like
It comes back to market.
it's just gonna appear on Zillow
Yep.
or wherever again.
Yeah.
There's no easy way to like set up.
It gets the
There's
agent.
services that do that. I expect.
Yeah. So we can search based on back to market.
Oh,
So
you
it's a
can?
status of once it's pending, which is under contract,
Yeah.
and then it comes back to market. We see it come through that
You can
way.
do that on like Zillow or anything.
No,
Is that
you can
what
do that
you
with an
do?
agent on the real
All
MLS.
right, okay. I know.
Silly Billies.
I know, I'm an agent, I'm got MLS. Yeah.
I know. Well, yeah,
So
no, and I
I'm
get that.
just-
No, I get that. The public facing sites like coming soon is still not feeding through the IDX. And we're seeing those. We get to see those now a week before. There's all kinds of bureaucracy I could go down rabbit holes with for you guys. But yes, when it comes back to market, it usually shows up as back on market, or it flips to active again, and you can see its history to see that it had been under contract. Real quick with the process. So the first thing you do is you turn in your earnest money. It's like a down payment. It's 1 to 2% of the purchase price, and it goes to the title company. That's your good faith funds to say, hey, I'm going to give you this $3,500, title company, not seller. Obviously, wouldn't that be weird? But I do like to remind people they cash that check. So a lot of times buyers have prepped and they have these great savings accounts. They write a check from their checking account. And they're like, I'm feeling good. I got my earnest money in, and it bounces. And it's like, oh, I didn't transfer the funds. Right. So we always remind everybody, like, remember, they're going to cash it. And the third party holds it, the title company, and it is applied to your purchase at closing. The first 7 to 10 days is going to be your due diligence period, depending upon how you've limited yourself on that with your offer variables, which we're not going to go down like I said, about going down all the rabbit holes. Can be too much, but you're going to do your due diligence at that time. You're going to pay for inspectors, a third party inspector. We have great referrals we can give you for that. We always want clients to feel empowered to pick their own inspectors because that's who's going to provide you with your like custom user's manual to your home. Right. And so that is going to be, depending upon the home, 500 to 1,000. If you have to bring out additional inspectors like structural or whatever, it could go up from there. That is money that if you terminate, you will not get back. It's paid to a third party. It's not tied to the transaction. Let's say the inspection goes awful and you're like, oh my gosh, this home is falling apart. I need my money back. You can terminate by deadline and get your earnest money back.
What was the other part of the money that you can't get back?
Inspections.
That's like stuff you pay like the general contractor.
Correct.
Yeah.
Yes, because you're paying third parties. It's not a part of the
Yeah.
transaction, but it's important it's not a part of the transaction because then there would be like they're the only person they're loyal to, and all of it is you.
I know in wholesaling they have a loophole. This is the back door. Well, one, it was like, well, that's like for assigning it. That's something else. That was the keeper in it. But we also had like, it was a contingent upon like satisfactory like inspection. Like basically if you're satisfied with what you see or not. Is that the same thing that you
Yep.
put in the contract?
It's exactly the same. And the inspection, you can terminate based on inspection of you doing your own inspection. You don't have to hire someone. I advise you hire someone, but let's say you are under contract on a home you haven't seen before,
Mhm.
and you go in and you realize that you didn't see it when you toured, but I don't know, furnace is disconnected, or I don't know, the whole place is shifty, right? And you're like, there's got to be huge structural issues. I'm gonna bow out of this and get my money back. Now, the good faith is that you're gonna move forward with the contract, right? But you can terminate based on that. We aren't willy-nilly with people going under contract and going out of it, because it's important that we, are helping buyers do their due diligence prior to even going under contract from a visual standpoint. So yeah. Second to third week, depending upon the time of closing, the lender is going to contact that third party appraisal management company, and they're going to send out an appraiser. The appraiser is going to confirm the value. That's $9,500 to $1,000. It's paid at closing as a part of your loan cost. If you terminate the contract, you are still paying for the appraisal. So they collect a credit card number from you. In the event you terminate the contract, they're going to charge that appraisal fee to you. Yeah. The appraiser is confirming the value for the bank. So it's a good protection for the buyer, but really in the end, they're protecting their end user, which is the bank who's giving you the loan. So it's always something to keep in mind. They're not someone you're hiring, but it's someone you're paying.
You do that after it's been accepted. It's in the contract.
Correct. So the majority of transactions, we do inspection first, then appraisal. There have been times where it made sense for a buyer to appraise first and then inspect. And so obviously we would honor that. But that's really a preference thing.
So it's just, they're just there to just confirm like, yeah, this house is actually worth what it is.
They're confirming it's worth what the lender is telling them it's worth. So that it can be sold into the secondary with the proper.
Oh, it's like Freddie Mac. So,
Usually, yep. Who their end user is usually the
then if you
secondary.
bail from it and they've already came, they're like, well, you pay us.
Correct.
That's
But you're not paying Freddie. Freddie Mac's not sending out the appraiser.
Yeah.
The appraisers are also 1099 contractors that are considered neutral parties. Yeah, but they're
Makes sense.
engaged by, yeah. We have title companies here in a lot of states. I don't know about Texas. I know in Illinois, you end up having to use a real estate attorney as well as a real estate agent, both sides. So you have a real estate attorney, a real estate agent on the buy side and sell side, plus the title company. It's just more people and it's more fees for the buyers. I love that in Colorado, you don't have to do that. So I did not go to law school. However, I have a limited ability to practice law within the forms that are given to us by the state of Colorado. So we have attorneys at the state that write the contracts for us. We fill in the blank. It's basically like Mad Libs. I'm kidding. I've never made that joke before. And I feel like that was a really good one. So I'm going to keep it. Have you ever done Mad Libs? Did you know what I was saying? Yeah. Like you're too, yeah, I get that. Yeah, I get that. Anyways, but we're filling in those blanks and it's very clear to you as a consumer, what we fill in, what's custom is blue and the rest of the contract is black. And so that way, I mean, you still should read it, but you can know and be confident that it's a contract that was created for the state of Colorado by attorneys that work for the state of Colorado. And like I said, the contract by default protects the buyer more than the seller because the buyer is taking on the liability. Title is on the back end scrubbing to make sure that there's no additional liens on the property from the seller. So they're going to make sure that all of the seller's liens, and they're insuring it, INSURE, ensuring that the property is free and clear of all liens from the previous owners, so that you're taking it on without any additional liens and the ones you're putting on the property. They also collect and disperse all the funds and acting, like a third party. They collect all the money, including nurse money, and then they're dispersing it at the end. I feel like the real estate side, I always feel like it's really intense the first week. Like, let's get your inspections. We're going to get this property disclosures from the owner, doing all these things first week. Okay, I feel good about it. Okay, we're going to wait for the appraisal to come back. And then you get into the loan approval piece. They already have you pre-underwritten, but then they're going to need some updated files from you. And so it's really about working with your lender and your realtor as a team. They're like your posse to get you to the closing table. We initiate and ensure that we are working closely with all lenders, even if they're not somebody we recommended or have a relationship with. Yes.
So right now I'm working with like multiple lenders.
Yeah.
And my buddy was like, it doesn't matter if you get pre-approved from, it matters like who you close with. That's when it gets locked in. At what point do you really want to, you don't want to be like hey, like who you gonna go with as a lender? Like when do you want to be like warming that up? I mean, you need it's like after you get your property accepted, after you get the
Yeah.
offer accepted.
So I would say within 24, 48 hours of going under contract, you need to have identified which lender you're moving forward with, especially when we're looking at like quick closes, because they need time to process it. The other thing I would tell you is that I think that there's a perception and potentially an earned one from real estate agents and lenders that like there should be something hush hush about it or whatever. I would be very upfront. Hey, I'm talking to a couple of lenders right now. Here's what I'm looking at. I'm going to need to make a decision pretty quickly once I go under contract. The lenders you're working with should understand that you're doing what's best for you. But also understand that a lot is required of lenders for buyers to get under contract right now. And so being fair with them from the beginning is really important, because there are a lot of times scrambling on the weekends to get you an updated lender letter, or taking the time out of their weekends. They work all week, they work all weekend, calling the listing agent. So, and ultimately everyone has access to the same rates.
Oh, what do you mean?
The rates are always the same.
Yeah.
Yeah. Advertised rates are different. Advertised rates aren't real a lot of times.
What, like pre-qualification rates?
No, like, but if you see an ad like Rocket Mortgage, for instance,
Like
right?
send you an email.
But ultimately, lenders have access to the same rates because they're all brokerages that are brokering with the end user and the end user, unless they're doing a loan that's a portfolio loan, meaning they keep it on their books.
So if one lender gives you a higher rate, they're marking it up more.
It could be limitations from their back end, and it could also be that the person who gave you the lower rate has points being paid down that you don't see. So you have to have them look.
Points from me. Or like,
right. You could be paying
shit.
additional fees. Like money comes in different places. And so every business like every loan company works a little differently. So you have to really, to compare apples to apples. That's why you want to have like, be honest with them and say, hey, this is what I got from them. This is what I got from you. Does it look different? A good lender is going to say, that's way better. You should go with them.
Yeah.
Send me your referrals, right? Let me know if there's anyone else I can help. I'm doing this because I have high integrity and I want to educate and empower you, right? So there's a lot of times hidden fees. So for instance, with new home builders, a lot of times there's a preferred lender that gives you $10,000 to use at the design center or something, but there's other fees elsewhere in there that helps make up with certain credits they may give you. So it's important to be able to look at them side by side, line item by line item.
And the fees would be on the pre-qualification.
Not always. The fees will be on the loan estimate. Yep. So you can ask them for a loan estimate. The LE.
But you can do that before having a property.
It's hard to do that before having a property.
Okay, so you need the property.
So, but you could give them a speculative property,
Okay.
like something similar to what you're
Something you
thinking.
haven't made an offer on, but it looks good.
Yeah.
It'd be like an ask for what was it?
Loan estimate. And that gives you the real numbers and stuff.
Okay.
Ultimately, when I see people like trying to rate shop, they are tripping over dollars to pick up dimes. Like it's so much time spent to maybe save $5 a month. Honestly.
On what, alone?
Yeah. It ends up being pretty comparable.
So just go with what?
Well, you have to go with who's going to get you to the closing table. You have to go with who you're gelling with. Like you need to go, there's other things that, it's the same way. Like, I don't go to McDonald's to get coffee. I go to Starbucks, right? Like I want a certain type of thing I want the service and I want, and then as an investor, like my lender has my file at all times. I would never shop rates because I know she's going to get it done and it's not going to be that different.
But I feel like you can just shop rates later once it goes lower and you want to refinance.
Correct.
If and when it goes lower.
Yeah. I mean, shopping rates like is more of a term that people use. It's not even a reality because they're so similar.
Yeah.
We'll talk about it more offline. I'm gonna get this
Okay.
finished up. Okay.
Oh.
Yeah. No, you're good. But either way, once you've decided on, you need to have your lender within 24 hours of going under contract, 48 max if it's over the weekend. You get your loan approval, you do a final walkthrough to make sure that the home is how you agreed to buy it, and then you close and you own a home. I went over. Man. Any other questions online? Otherwise, we're gonna let you folks go. Perfect. Thank you so much. We'll get the recording out tomorrow. I think we had more RSVPs. It didn't make it online because they were going to look at the recording. So we'll make sure we get that out. I don't think I swore too much, and we'll see you on the next one.
Thank you. Bye.
Bye.
Oh, yeah. Share and